Welcome to the Deep Dive. We've got the Q2 2025 earnings call transcript for Bright Horizons Family Solutions right here.
Yep.
And today, our mission is really to cut through those numbers, pull out the key insights, and, understand what's really driving things for them.
Absolutely. They're a big player in that employer-sponsored childcare space.
Exactly. So we'll unpack the financials, the operational stuff, and what management's seeing ahead for the company and, well, for you listening.
And what jumps out right away is that Bright Horizons didn't just meet expectations this quarter. They genuinely blew past them.
Really?
Yeah, it signals a company that's really hitting its stride, turning strong execution into some significant financial wins. It feels like this quarter really validated their whole strategic direction.
Okay, that's a strong way to put it. Let's dive straight into those headline numbers then, because they really do set the scene.
For sure.
So Bright Horizons delivered a remarkably robust Q2. Their GAAP EPS, that's the standard earnings per share, it shot up to 95 cents.
Which is a stunning 42% increase year over year. 42%.
Wow. And if we look at their non-GAAP, or, the adjusted EPS, that often gives a clear picture of ongoing operations.
Right, excluding the one-offs.
That surged 22% year over year to $1.07.
And what's fascinating, I think, is how that top-line growth converted so efficiently down to the bottom line. Revenue climbed to $731.6 million.
Okay, so up a solid 9% from last year and also beating estimates.
Handily beating them, yeah. But the real story, I'd argue, is the operating leverage. Look at adjusted EBITDA, basically. Earnings before all the interest, taxes, depreciation, amortization.
It's a good proxy for cash flow, right?
Exactly. That grew even faster, 13% to $115.6 million. And that translates to a really impressive 16% margin.
16%. So they're not just growing, they're growing more profitably.
Precisely.
Right. And income from operations, another key indicator of core business health, saw a big 25% jump, hitting $86.1 million.
Yeah, these aren't just isolated wins. It feels like genuinely strong operating leverage and effective execution across the whole business.
And just for context, their network scale is still huge, right? 1,020 centers.
Yep, 1,020 centers, roughly 115,000 capacity as of the end of June.
Okay, so let's dig a bit deeper then. What were the absolute core drivers behind this impressive operating strength?
It really boiled down to two main areas. First, a pretty significant increase in utilization within their backup care services. That segment is proving to be a real high-growth engine for them. And second, you had a healthy mix of enrollment gains and tuition price increases across the full-service centers.
Right.
Management kept emphasizing disciplined execution, and they reiterated how essential their services are perceived by working families and, importantly, their employers. It also speaks to their financial discipline. They improved their net debt to adjusted EBITDA ratio down to 1.7 times.
Down from 1.9 times last quarter.
Exactly. That metric basically shows how quickly they could pay off debt. So they significantly deleveraged, strengthened their financial position. That's thanks to strong cash flow and some strategic stock buybacks.
That's definitely a clear signal of robust financial health. Let's focus on that backup care segment for a minute, because it really does look like a star performer.
Oh, absolutely.
Revenue there jumped, 19% to $163 million.
19%, yeah.
What's driving that kind of acceleration? I mean, that's fast. And how are they actually meeting that demand?
Well, the acceleration is coming directly from heightened client and user engagement. Simple as that, really. Demand was particularly high for center care, camp care, and in-home care, especially, during the summer, which is always a seasonally strong period for them.
Makes sense.
And what's really a testament to their value proposition, I think, is landing McKesson, a Fortune 10 employer, as a new backup care client this quarter.
Wow, Fortune 10, that's a huge endorsement.
It really is. It just underscores that continued interest from very large employers who need high-quality, reliable care solutions.
So how were they managing to scale up capacity to meet this demand without, overstretching themselves?
It's actually a pretty smart multi-pronged approach. They've strategically expanded supply using both their own assets, like their Stephen Care camps, and the Jovi Nanny agency.
Okay.
And also, they diligently expanding their third-party partnerships with other care providers.
So a hybrid model.
Exactly. It gives them better geographic reach and a broader range of programs, more flexibility for employers and families. Plus, this segment is incredibly profitable.
Right.
Adjusted operating income was $41 million. That translates to strong operating margins of 25%. And they expect to keep those margins in the 25-30% range for the full year.
25 to 30% margins. That's healthy.
Very healthy. In fact, they actually increased their full year expectations for backup care revenue growth, now looking at an impressive 14-16%.
14 to 60% growth for the year.
Oh.
Okay. So backup care, clearly a growth engine, great margins. Now, let's pivot to the full service centers. That's the traditional cornerstone, right?
That's right.
How did that segment perform? And what are the key enrollment dynamics you're seeing there?
Full service revenue grew a solid 7% to $540 million. That was driven by, well, a mix. Enrollment growth, tuition increases, and 5 new center openings.
Okay.
And interestingly, 2 of those new centers were actually for an existing client, the University of Virginia, which uses multiple services. So that speaks to their ability to deepen relationships.
Good point.
Enrollment in centers that have been open over a year, that increased at a low single-digit rate, but it was enough to push their average occupancy up into the high 60% range.
High 60s. Okay.
And Q2 is typically their peak enrollment period, so hitting that mark was pretty critical.
That's definitely a good step forward. But where exactly is that enrollment growth coming from within that huge network? Is it even across the board, or are they focusing on specific areas?
Yeah, this is where it gets really interesting for their margin story, I think. The fastest growth is actually happening in the centers that were previously below 40% occupancy.
The underperformers are picking up.
Exactly. They're seeing really meaningful improvement in those locations. Then at the other end, their top cohort centers running above 70% occupancy, that group actually expanded to 54% of all centers now.
Okay.
And they're maintaining average occupancy above 80%. So management was pretty clear. They said there's no structural reason why they can't get back to those pre-COVID operating margins of 9-10% for the full service business.
9 to 10%. So what's the strategy to get there?
It's kind of twofold. One, improve those middle and bottom cohort centers, get them performing better. And 2, strategically rationalize the real underperformers. About 10% of their centers are currently operating at a loss. So they're looking closely at those.
That sounds like a very targeted approach to boosting profitability. And beyond just managing the centers they have, are they making it easier for, new families to actually enroll?
Right. Absolutely. They're investing quite heavily in streamlining that whole path from the first inquiry right through to enrollment.
How so?
Well, things like enhanced technology for their website, providing sort of white glove support from dedicated enrollment managers, and more proactive communication to help families navigate their choices.
Makes sense.
They're also strategically prioritizing infant and toddler enrollment. That's an area where there's typically less market supply. And it offers a good long-term opportunity as those kids, age up through their programs.
Right, staying within the system. Okay, let's shift gears across the pond. The UK market. That's been a story of big investment and turnaround efforts, hasn't it?
It really has, and the news there continues to be positive. Strong operational and financial momentum continued in Q2.
So solid growth.
Solid growth in both enrollment and margins. And that's a direct result of the investments they've made over the past couple of years, staffing, tech, programming. It's also worth noting, Bright Horizons UK was recognized as one of Europe's best employers by Great Place to Work this quarter.
Oh, wow.
And crucially, the company remains firmly on track to hit break even in the UK by the end of this year, 2025.
Break even by year end. That's a huge turnaround from last year's, nearly $10 million loss.
Exactly. Nearly $10 million in losses last year. So yeah, it's supported by their execution, but also helped by an expanded government funding program there. It really demonstrates their ability to execute on these big strategic initiatives.
That is an impressive turnaround. Okay, quickly, what about their education advisory segment?
That segment also saw healthy growth. Revenue was up 8% to $29 million. Driven by solid participant and usage growth, particularly in their college coach service. And this really ties into their broader One Bright Horizon strategy, offering that full integrated spectrum of family benefits to employers.
Okay, let's talk more about that One Bright Horizon strategy.
Yeah.
What's the sort of overarching narrative for the company's future growth? And what other strategic catalysts are maybe at play?
Well, the One Bright Horizon strategy is really all about expanding services within their existing client base.
Cross-selling, basically.
Exactly. We saw good examples this quarter. Centara added backup care services. Northwell Health introduced College Coach. It just demonstrates the power of that employer-sponsored model. Once you have the client relationship, you can offer a wider suite of relevant services.
Makes sense.
And this quarter also brought a pretty significant positive on the policy front. the updated 45F tax credit program.
45F. Remind us what that is.
Sure. It's a U.S. federal tax credit designed to incentivize employers to provide childcare benefits. And it just got a major boost. The credit for employer-supported childcare spending increased pretty dramatically from $150,000 up to $500,000 per employer.
Wow, from $150K to $500K. That sounds like a huge potential tailwind for employers using their services.
It certainly is.
How is Bright Horizons positioning itself to leverage that?
Well, it's definitely a powerful incentive for their existing clients, right? It gives them a really attractive way to benefit more from the investments they're already making in childcare.
But what about attracting new clients?
Management was a bit more cautious there, actually. They're optimistic, but noted that historically, tax credits haven't been the primary driver for new demand. The sales cycle for these big B2B benefits contracts can be quite long, you see.
Right, it's not an impulse buy.
Exactly. But that said, their sales and marketing teams are actively educating both prospects and existing clients about 45F. They're trying to help bridge the gap between, say, HR and finance departments within client companies to really maximize its use.
Okay, so it's more about deepening existing relationships and maybe sweetening the pot for current partners. So what's the company's long-term trajectory look like then? Are they still focused on just opening more centers, or is the focus shifting?
The focus has definitely shifted. Management explicitly characterized their long-term trajectory as a margin and mix story rather than footprint expansion at any cost.
Margin and mix, meaning?
Meaning they're optimizing their existing infrastructure and services, making what they have more profitable and efficient rather than just aggressively building new centers everywhere. So, future growth catalysts. They're looking at continued high utilization in backup care, ongoing enrollment gains and tuition increases in the centers, and obviously securing new large employer contracts or maybe integrating into more benefits platforms.
And the challenges. Macro stuff.
Yeah. Macro variables like labor availability and wage inflation are still important factors, especially for center profitability. Management says they're actively addressing those through strategic investments and trying to find operational efficiencies. Plus, that aging up trend we mentioned.
Right. Infants moving to older groups.
That naturally provides some positive operating leverage because the economics get more favorable.
Okay, this all paints a pretty confident picture. What do they say about guidance? The outlook for the rest of 2025.
For the full year, they updated revenue guidance slightly, now looking at $2.90 to $2.92 billion. That reflects about an 8-9% reported growth rate.
And earnings.
Diluted adjusted EPS guidance was reiterated at $4.15 to $4.25 per share, so holding steady there.
Okay, and for Q3 specifically?
For Q3, the outlook projects revenue between $775 and $785 million and adjusted EPS in the range of $1.29 to $1.34 per share.
And the segment outlooks remain strong.
Yeah, pretty robust. Full-service revenue growth expected around 5.75, 6.75%. Backup care, as we discussed, 14-16% growth.
Wow.
And education advisory in the mid-single digits. And those backup care margins expected to stay strong, 25-30%.
All right, so the market clearly must have liked this strong showing. How did investors react after the earnings release?
Oh, yeah. The reaction was overwhelmingly positive. Shares surged 10.6% the day after the release.
10%. That's a big move.
Huge move. Closed at $125.10. And trading volume spiked, too, roughly 3 times the average from the day before.
Wow.
So you definitely got this constructively bullish sentiment. Strong buy-side approval for not just beating on revenue and EPS, but also delivering that impressive margin expansion. And, crucially, maintaining the higher guidance.
So investors are buying into the story.
It really seems like it. It highlights confidence in their diversified model, leveraging those secular tailwinds in family benefits and executing with discipline.
Yeah, it sounds like investors believe they are effectively executing that One Bright Horizon strategy, leveraging the asset-light backup care model while systematically improving profitability in the full-service centers.
Exactly.
And the cautious but positive view on the 45F tax credit probably resonates too, shows a measured, pragmatic approach.
Precisely. The narrative isn't just pure growth anymore, it's about quality growth, driven by optimizing what they have and leveraging their core strengths. And this earnings call, I think, provided plenty of evidence that they're making good progress on that vision.
Okay, this is the deep dive. And you know what that means? It's time for the This Is Not Financial Advice segment. We like to stretch our thinking a bit here. Considering this really robust quarter, what's a bold, maybe even slightly outrageous, but still plausible strategic play or investment theme that comes to mind for you? based on everything we just unpacked?
Okay, yeah, let's get creative. For an investment committee thinking strategically, I might propose two compelling, maybe bold thematic plays here. First, let's call it a return to form leveraged growth play.
Okay.
The core thesis is validated, right? Backup care, high growth, high margin, full service, clear, if slower, path back to pre-COVID profitability. We're not betting on a sudden explosion, but more like a steady march back as that margin and mix story plays out.
So the bet is on.
The strategic bet is squarely on their operational execution. Specifically, can they successfully convert that middle cohort, the 40-70% occupancy centers, into higher performers? And can they actually hit that UK break-even goal by year end?
Right.
If they nail those operational targets, the margin leverage could be significant, meaning each incremental dollar of revenue generates a lot more profit. So it's less a bet on the overall market and more a bet on management's ability to optimize the assets they already have.
I like that focus. Betting on internal execution. What's your second theme?
Okay, second, let's think about a cross-sector S in ESG alpha play.
The S in ESG social.
Exactly. Go long, Bright Horizons, playing that continued secular tailwind of employer-sponsored family benefits. It aligns perfectly with the social aspect of ESG supporting workforce well-being, retention, diversity, all that.
And you pair it with?
Pair it with a short position in, say, a traditional capital-intensive cyclical industrial stock, one that's highly sensitive to rising labor costs and has maybe a less clear or even negative social impact story.
Okay, what's the rationale there?
The rationale is that Bright Horizons' disciplined execution and deep integration with client HR benefits might give it some insulation from broader economic swings, especially as companies increasingly prioritize employee well-being to attract and keep talent in tight labor markets.
So the short hedges market risk.
Right. The short side hedges against a potential broader market downturn, while you capitalize on the potential divergence in how companies get valued based on their human capital strategies and social impact. You're essentially betting that the premium commanded by the S in ESG will outperform traditional industrial plays over, say, the next 12-18 months. As companies talk more about employee benefits, BH looks like an enabler, while others struggling with labor might see their multiples compress.
Those are definitely provocative thoughts, stretching the implications of this earnings report into some broader market themes. All right, let's recap quickly. Bright Horizons delivered a really standout Q2.
Definitely outperformed.
Significant top-line growth, impressive margin expansion. The strength in backup care utilization combined with that steady, disciplined execution in the full-service centers really underscores their market position and effective strategy.
Yeah, and management's updated guidance reflects real confidence in continued momentum through the second half of 2025. It paints a pretty constructively bullish picture. They're focused on margin and mix optimization, not just growth at any cost. Plus, that pragmatic approach to the 45F tax credit, it positions them intelligently, I think.
Agreed. And as always, this discussion is purely for informational purposes. It should absolutely not be considered financial advice. Investors should always conduct their own thorough due diligence.
Always.
Now, for you, our listener, here's a final thought to maybe mull over. As more and more companies truly internalize that employee well-being isn't just nice to have, but a core business strategy, how might that fundamentally reshape the entire market for services like Bright Horizons, perhaps even beyond what we talked about today? Something to think about. Thank you for joining us on this deep dive.